Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Battalion Oil.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's jump straight in. So imagine you're watching a stock, right? Maybe it's one you had your eye on, or maybe you even hold it in your portfolio right now.
Right.
You watch it surge, like an absolute massive 130%, and you're thinking, okay, this is it. This is the breakout.
Oh yeah, the classic euphoria phase.
Exactly.
Yeah.
But then, almost as quickly as it climbed, it just plummets. 40% in a single trading day. I mean, that is the exact, just brutal roller coaster that Battalion Oil has been riding recently.
It's the very definition of extreme volatility, really, because what we're looking at here is a classic coiled spring setup.
A coiled spring.
Yeah, it's a situation where the market's reaction is just so violent and so rapid that it creates this massive distortion, a distortion between the actual real value of the underlying business and, the price that's blinking red on your screen.
Right, and that distortion, that's exactly our mission for you today. We really need to look past these whiplash headlines to figure out what's actually happening under the hood.
Exactly.
Because, I mean, is this a falling knife that you need to just stay far, far away from? Or are we looking at a rare asymmetric wealth-building opportunity that the broader market is just, well, completely mispricing?
That's the million-dollar question.
Right. So a 40% drop in one trading session, that was on March 25th, and that is just maximum pain for anyone holding. So let's start with the immediate damage. What actually caused that floor to fall out so fast?
Well, it was essentially a perfect storm. We had two major shocks hit the stock at the exact same time.
Okay, two shocks.
Yeah. Let's start with the local company-specific one. They released their fourth quarter 2025 earnings, and, I mean, there's no sugarcoating it. It was undeniably a miss.
How bad of a miss?
Revenue dropped to $32.3 million. And for context, they were at $49.7 million the year before.
Oh, wow. Yeah, that's a steep drop.
It is. And along with that, they reported an adjusted earnings per share loss of $1.16.
Okay, let's just pause on that for a second. Because if you're an algorithm, right, just scraping financial headlines, a drop from nearly 50 million to 32 million is an immediate hard sell trigger.
Oh, absolutely.
Like an algorithmic trading bot. It doesn't care about the broader context or the operational adjustments the company's making. It just sees revenue shrinking year over year and aggressively hits the bid.
That's such a crucial point about modern market mechanics. The algos just sell the headline instantly, they don't think.
Right.
But the second shock was macroeconomic. And arguably, it actually had an even bigger impact on the stock's daily action.
You're talking about the Trump-Iran pause, right?
Yes, exactly. We saw a 5-day pause on strikes announced, which led to this immediate geopolitical de-escalation in the Middle East.
And when geopolitical tensions ease, the fear premium just comes right out of the barrel. I mean, crude oil prices completely collapsed because the threat to the global supply chain suddenly looked, a lot less imminent.
Precisely. And you really have to understand the specific way Battalion Oil trades to see why this matters so much.
How so?
It operates as a high beta proxy for overall oil sentiment.
High beta. So super sensitive.
Exactly. High beta basically just means it is hypersensitive to broader market moves. If the overall energy sector sneezes, a stock like this catches a severe cold.
That makes sense.
So when institutional money rotates out of the energy sector because oil prices are dropping, a smaller cap stock feels that exit exponentially. There's just less liquidity to absorb the selling pressure.
Right. Let's visualize how this dynamic works for a second. It's sort of like having a speedboat, right? A speedboat with a flawless high-performance engine.
Okay, I like this analogy.
But you're trying to drive it through this narrow, rocky channel during a violent hurricane.
Yeah, good luck with that.
Exactly. It honestly doesn't matter how good the boat's engine is or how well built the hull is. The macro weather environment is so overwhelmingly powerful that it's going to smash you into the rocks regardless.
Yeah.
You are completely at the mercy of the macro storm in the very short term.
That captures the reality perfectly. The underlying mechanics of the company get entirely overshadowed by the storm.
Yeah.
And the key takeaway for you, the listener, is understanding this current market psychology. The sentiment right now is heavily heavily bearish.
For sure.
But when you see washout selling of this magnitude where a stock drops 40% in one session, that often marks what we call a capitulation bottom.
Let's break down that term for a second, just to be clear. Capitulation is essentially the point of maximum exhaustion, right?
Yes.
Okay.
It's the moment when the last terrified seller finally just throws in the towel.
The ultimate give up.
Right. And it's not just regular people deciding to sell. It's margin calls triggering, stop losses getting blown out, and pure panic just taking over the tape. It flushes out all the weak hands.
So there's literally no one left to sell.
That's the idea. Historically, those moments of maximum pessimism where the selling pressure literally exhausts itself can be the exact point where contrarian investors start building real wealth.
Because once the sellers are gone, the only direction left is up.
Right.
Well, assuming the company actually has a pulse, of course.
Right. A very important caveat.
Which brings us to the most important question. What is the actual state of that speedboat's engine?
Let's look under the hood.
Yeah. We know the stock is being punished for the Q4 numbers and the geopolitical storm, but what is management actually doing to fix the mechanics of the business behind the scenes?
Well, this is where the story shifts. It goes from a panic narrative to a really fascinating turnaround strategy.
Okay, I'm listening.
If you zoom out from that one ugly quarter and look at the broader baseline, it's actually surprisingly robust.
Really? Even with the 32 million Q4?
Yeah. Their trailing 12-month revenue, so looking at the entire year's performance, not just Q4, is $183.4 million.
Okay, that's a very different picture.
It is. And furthermore, their operational cash flow sits at a very healthy $27.97 million.
Wait, 27.97 million in positive cash flow.
Exactly. So, this is not a dying company failing to generate cash.
Okay, but I have to push back here, though.
Sure.
You mentioned healthy cash flow, but they just executed a $60.1 million sale of their West Quito Draw assets in March 2026.
They did.
If the business is doing fine, why are they selling off massive chunks of their operating footprint? I mean, to an outside observer, that doesn't look like a growth strategy. That looks like a distressed company selling the living room furniture just to keep the lights on and make payroll.
That is a completely valid concern, and honestly, it's exactly what the surface-level market is assuming right now.
It's the logical conclusion.
It is, but we have to dig into the actual mechanics of the oil exploration industry to understand what a move like this really means.
Okay.
Because they didn't sell that asset to pay for executive bonuses or, to fund day-to-day operations.
Where did the money go?
They took $40 million of those proceeds and used it to strictly prepay debt.
Wait, $40 million straight to the balance sheet.
Straight to the debt.
Wow. I mean, that is a massive chunk of capital to allocate solely to debt reduction.
It's huge, and here's why it matters so much. In the world of small-cap exploration and production, or EMP, debt is an absolute killer.
Because of the price swings.
Exactly. Oil prices are incredibly volatile, as we just discussed. So if you have a massive load of fixed, high-interest debt, and the price of crude suddenly drops,
your margins just evaporate.
They vanish entirely. Those interest payments eat up every single dollar of your cash flow. It can literally bankrupt a small energy company overnight.
So paying that down, this wasn't just a spreadsheet adjustment for them. This was a survival tactic. They're basically removing the most dangerous variable from their financial equation.
Exactly. By aggressively paying down that much debt, they are fundamentally altering the company's financial DNA.
Changing the whole profile.
Right. They're shifting the narrative entirely from, we are a distressed company struggling to survive our leverage, to, we are actively restructuring our balance sheet for growth.
That's a huge pivot.
It's a massive de-risking move that drastically lowers their break-even point on every single barrel of oil they pump.
Okay, that actually makes a lot of sense. They're shrinking to grow.
Yeah.
They're trimming the fat to save the muscle.
That's a good way to put it.
But if they sold off West Quito Draw, where is the actual growth going to come from? Because you can't just cut your way to a massive valuation. You still need an engine that produces revenue.
And they have acquired a very powerful new engine.
Oh.
Yeah, they're pivoting hard from a harvest mode, which just means pulling oil out of older, declining wells into a highly targeted growth mode.
Was the target?
They recently acquired 7,090 net acres in the Delaware Basin.
Okay, for anyone not deeply embedded in the energy sector, the Delaware Basin isn't just random Texas scrubland.
Not at all.
That is premier top-tier real estate.
Right.
It's known for being incredibly liquids rich.
And that geological distinction is crucial. Liquids rich means they are pulling up highly profitable crude oil and natural gas liquids rather than just, cheaper, dried natural gas.
Better margins on the liquids.
Way better. Plus, the Delaware Basin has multiple stacked pay zones.
Stacked pay zones.
Yeah, it's essentially layer cake geology. You can drill down and hit multiple oil-bearing rock formations from a single surface pad.
Oh, wow. Which means your return on investment for every hole you punch in the ground is significantly higher.
Precisely. They are expanding what they call their monument draw base, and we're already seeing concrete operational momentum from this pivot.
What kind of numbers are we seeing?
They've reported a 1,200 barrel per day production increase in the southern Delaware Basin.
1,200 barrels a day.
Yeah. So the narrative that they're just shrinking isn't true at all. They're swapping less efficient, older assets for highly efficient premium acreage.
Let's talk about their competitive moat here, too.
Yeah.
Because it isn't just about owning good land, right? It's about the infrastructure. Think of it like owning a massive manufacturing plant that's only running at, say, 50% capacity.
Okay.
When you buy the warehouse right next door, you don't need to spend millions building a new shipping department, hiring a new HR team, or running a brand new power grid.
Right. You already have all of that.
Exactly. You just route the new products through your existing, already paid-for system.
That analogy perfectly illustrates their capital efficiency. Battalion Oil is acting as a local consolidator. They're adding this new 7,090-acre footprint directly adjacent to their existing infrastructure.
Which saves a fortune.
It does. In the oil business, capital expenditure, the upfront cost of building out pipelines, water disposal facilities, and processing plants that can absolutely ruin your profit margins.
Yeah, the CapEx can be a black hole.
But by utilizing what they already have, their capital efficiency is vastly superior to a competitor who has to come in and build everything from scratch.
It's just smart business. You drastically lower your overhead while increasing your output. And, it seems like the retail market completely missed this structural advantage during that 40% sell-off.
Oh, retail panicked.
But the institutional side certainly didn't miss it.
No, they didn't. While retail investors were panic selling, the smart money was quietly stepping in to capitalize on the fear.
What did they do?
Well, in early March, the company closed a $15 million private placement.
$15 million.
Yeah, and the most crucial detail here is the price. They raised that capital at $5.50 per share.
Okay, that $5.50 price tag, that is a massive signal for you, the listener.
Huge signal.
Because institutional investors do not just hand over $15 million without doing exhaustive forensic due diligence. They don't just read the headline earnings miss and react.
Definitely not. They have teams of analysts.
Right. They look deep into the debt profile. They analyze the geological surveys of the new acreage. They run the production numbers. And they decided that $5.50 was a price where they felt incredibly comfortable locking up their capital.
Exactly. It effectively creates a psychological and financial floor for the stock price.
A floor of support.
Right. It tells the broader market that the big players see underlying value right at that level. So when the geopolitical noise drags the price down to or below that institutional floor, it starts to look less like a crisis and much more like an extreme discount.
Let's summarize where we stand for a second. The balance sheet is heavily de-risked with that $40 million debt prepayment.
Check.
They have a premier, highly efficient moat in the Delaware Basin.
Check.
And they have a stamp of approval from institutional backers at $5.50 a share.
Exactly.
But as we know, a cheap stock can stay cheap forever if there's no immediate reason for it to move.
That's the trap of value investing sometimes.
Right. So let's look at the horizon. What are the specific events over the next 1 to 3 months that could unlock this coiled spring?
Well, the beauty of this setup is how logically the upcoming catalysts connect to the turnaround strategy we just discussed.
Okay, walk us through them.
Let's start with the ultimate endgame for a company like this. The rumor mill is generating a lot of heat right now around Battalion Oil becoming an acquisition target.
Which honestly makes perfect sense. They've cleaned up the balance sheet and consolidated premium land. They're essentially dressing themselves up for a buyer.
Exactly. Larger basin consolidators are always hunting for discounted producing assets. The industry term for this is PDP, or Proved Developed Producing Reserves.
Let's explain why PDP is the absolute holy grail for a major oil company looking to acquire.
It's all about risk.
Right. When you buy PDP, the hard, risky work is already done. You don't have to guess if there's oil thousands of feet underground.
No wildcatting.
Exactly. You don't have to spend tens of millions of dollars drilling speculative exploratory wells that might just turn up dry. The oil's already flowing. You literally just turn the tap and collect the cash flow.
It's plug and play.
That is why the big players are willing to pay a massive premium for it.
And by consolidating around prime Delaware Basin infrastructure and paying off that suffocating debt, Battalion has transformed itself into a very attractive, bite-sized, low-risk acquisition for a major player.
A perfect target.
If a buyout gets announced, that is the home run scenario where a massive premium is instantly priced into the stock.
But, we can't base a wealth-building strategy purely on acquisition rumors. We need concrete drivers.
Fair enough.
And that brings us back to the macro environment acting as the wind in the sails of this localized turnaround.
Yeah.
The 5-day pause on strikes brought oil prices down, but the geopolitical reality of the Middle East hasn't structurally changed at all.
It really hasn't. The pause is just a temporary reprieve. Tensions around critical global choke points, particularly the Strait of Hormuz, they remain incredibly fragile.
Yeah, that's a massive choke point.
About a fifth of the world's daily oil consumption passes through that single strait.
A fifth?
Yeah. Any failure in negotiations or any renewed escalation could send crude prices surging higher overnight. And because Battalion is that high beta proxy we talked about earlier,
it stands to capture those upward spikes violently.
Exactly.
So the macro storm that pushed them against the rocks could easily shift and pull them right back out to sea.
Very easily.
Meanwhile, on the operational side, we are waiting for proof that this new factory is actually working.
And that proof will come in the upcoming Q1 2026 earnings.
What are we looking for there?
The market needs mathematical proof that the turnaround is executing. Investors should be watching those operational updates like hawks for details on the integration of those 7,090 net acres.
Seeing if the new land is paying off.
Right. We need confirmation that they are efficiently drilling and pulling profitable, liquids-rich oil from that new acquisition.
And when they prove that, it completely destroys the bearish narrative that they're a shrinking company.
Completely.
But perhaps the most guaranteed catalyst ties right back to that $40 million debt prepayment we discussed earlier.
Yes. The market has an incredibly short memory.
So true.
The algorithmic bots reacted violently to the Q4 revenue drop, but they haven't fully priced in the impact of the massive debt reduction yet, simply because it hasn't shown up on a formalized quarterly report.
Oh, I see. It's not in the automated data feed yet.
Exactly. When the next financial filings drop, the market is finally going to see the massively reduced interest expenses. They're going to see that cash flow suddenly freed up and hitting the bottom line.
And algorithms will love that.
They will. That will serve as undeniable mathematical proof of a fundamentally healthier company.
So putting all of these pieces together, we've got the de-risked balance sheet, the premier assets, the institutional floor, and the upcoming catalysts.
Right.
What is our final verdict on this? How should you be looking at this in the context of your own wealth-building journey?
Based on the underlying fundamentals and the extreme technical setup, this registers as a 6 out of 10 speculative buy.
6 out of 10 speculative buy.
Yeah. It is the very definition of a high-risk, high-reward turnaround play.
And let's heavily emphasize the words speculative and high risk. I mean, this is not a set it and forget it blue chip dividend stock that you pass down to your grandchildren.
Oh, not at all. The target horizon here is a swing trade, looking at a 1 to 3 month window.
A kite window.
Yeah, it relies on a stabilization of oil prices and the broader market finally waking up to the drastically improved balance sheet. Because of its extreme sensitivity to commodity prices and those unpredictable geopolitical macro events, it requires very strict risk management on your part.
You have to be disciplined.
Absolutely. You have to know your exit points, size your position appropriately, and actively protect your downside.
Absolutely. You don't ride a high-performance speedboat through choppy waters without wearing a life jacket.
Good rule of thumb.
So let's synthesize all of this for you. Right now, the broader market is violently punishing Battalion Oil. Algorithms and retail investors are obsessing over a temporary Q4 earnings miss and some short-term geopolitical noise.
They're blinded by the news cycle.
Right. But that panic is completely masking the reality of a newly de-risked balance sheet, a highly strategic pivot into premium Delaware Basin acreage, and a literal $15 million institutional floor placed firmly at $5.50 a share.
The disconnect between the headline price flashing on the screen and the underlying structural business value is massive right now.
Massive.
It's a textbook example of how sudden market fear can create remarkable opportunity for those willing to look under the hood and understand the true mechanics of the business.
Which leaves us with one final provocative thought for you to mull over. In a market that is so deeply obsessed with macro geopolitical headlines, where algorithms are just blindly trading the news cycle at the speed of light,
Yeah.
how many fundamentally sound local turnaround stores are being completely mispriced right under our noses?
Yeah.
I mean, if the macro tide is hiding the true value of the underlying business, the smartest move might just be waiting for the water to settle.
It is the core philosophy of strategic wealth building. Find the fundamental value that everyone else is simply too panicked to see.
Couldn't have said it better. Thank you for tuning in. We'll see you next time as we continue to find those hidden opportunities to build your wealth.